there is no better company that I would like to allocate capital to than people that have even more concentration risk.
But you're essentially outsourcing to a group of founders who you've handpicked from a very large universe. I've always been interested in founder-led companies. Entrepreneurs and family-run companies often have unconventional attitudes to risk and return. They often back themselves to take operational risk. They tend to be more innovative. You could say they are more prone to being maverick. But also you could say that they are more cautious and mindful of capital preservation and the value of staying in the game for the benefit of future generations. Investing to capture the founder-led effect is a way to achieve an asymmetric return, with better downside protection in tough times and higher upside returns in good. Sounds great in theory, but how do you go about it in practice? In this episode, I chat with a Chinese-Australian who invests globally in founder-led companies. Lawrence Lam has run the Lumenary Global Founders Fund since 2017. As the name suggests, its process attempts to identify companies that are run for the long term and have the founder effect. So what is the founder effect, and how can investors determine whether a management team has this elusive characteristic? Well, helpfully, Lawrence has written a book called The Founder Effect, The Three Pillars of Success in Founder-Led Companies. It's a great read if you are trying to understand good long-term management decisions and how to spot them. This is a fascinating conversation with someone who loves what he does and scours the world's stock markets to find his secret formula at work. We learn how he balances the less correlated world for opportunities to buy founder-led companies that offer particularly good value, why China offers a great way to diversify a portfolio, how BYD is poised to become the next Toyota, and how meeting management might be useful for understanding if the company is likely to do well in the next quarter, but not so useful for understanding whether it will compound for you over the next couple of decades. As Lawrence says, he looks for the long-term track record of key decision-making, simple organisational structures, skin in the game, and a close alignment with the interests of shareholders. As always, none of what you're about to hear is financial or any other type of advice. It is hopefully entertaining and informative, but what you hear should not be used as the basis for an investment decision. Please take personal financial advice before investing a penny of your money in these crazy markets. And with that, please enjoy my conversation with the maverick Lawrence Lam.
Brought to you by Progressive Equity.
Can we just start with a little bit of background on you? How did you get into fund management, and what inspired you to set up Lumenary?
Well, looking forward to the chat, Jeremy. I've been running Lumenary for the past 8 years. Prior to that, I was actually in investment banking, in structured finance, working for Royal Bank of Scotland and MUFG. And prior to that, I was at Deloitte with derivatives advisory team. And then prior to that, my first role was actually with APRA, which is the Australian federal regulator. And personally, I found it a little bit boring, and that's why I left. I wanted to get into the private space. Your first job really shapes how you see the world. And for me, because APRA is a federal regulator, very focused on risk management, that certainly shaped how I saw business, how I saw running of businesses. And that put me in good stead to, one, see a wide range of companies, but two, have just a mindset towards what are they doing that protects them from any unexpected turbulence.
That's really interesting. One of the things I wanted to ask you was, how do you think about risk and how do you mitigate against it when you're building your portfolio?
I think that's an often underestimated part of investment management is people are often very enamored with, stock picking, stock stories of individual companies, coming up with a thesis for companies. And certainly that's a big part of investing, but we can't know everything about every company. And so it is incredibly important to manage on a holistic portfolio basis. And what I mean by that is, for most investors, if you're a private investor, just to have at least 20 stocks in a portfolio. And that's certainly one of the lessons I've learned during my time running Lumenary, is not to be over-concentrated. And the fund has evolved now into a strategy where we take companies that are overheated, trim the profits that we've got, and then recycle that into companies that are relatively undervalued. And over time, I think that de-risks the portfolio, because if you imagine the average PE ratio of your portfolio, you're kind of constantly trying to bring that down and lower that down.
Knowing what we don't know is an important aspect, I think, of understanding risk. Interesting that you come from a background as a regulator where so many people in our industry, in financial services, seem to have reached a definition of risk that is to do with volatility.
In academia, risk is obviously volatility, but then a lot of people, you'll hear funds managers say, well, risk is actually the permanent loss of capital. That often seems to be a common description of risk. But if you go, as you say, one level deeper, it's actually, well, what could lead to that permanent loss of capital? Well, it's things that you don't know. When you're investing in founder-led companies, inherently, there is more upside, but there is potentially more downside. And here in Australia, we have seen several founder-led companies with controversy, and even around the world with, say, Elon Musk of late, where there is huge risk with one person taking such a center stage of the whole company.
I'm very interested to understand, for your purposes of investing, how you define a founder or how you define a founder-led business. What are the characteristics you can screen for that tell you this is what I'm looking for? Because you're essentially looking for a needle in a haystack.
Yeah, I mean, every company starts off as founder-led, and they don't often end up all staying founder-led. Only a very select few are able to reach the heights of IPO and then long-term decades of success. So that's not very common. In terms of my investment process, I actually start very wide. I start with roughly, all the major listed stock markets, about 40,000 listed companies or so. From there, I'm actually looking for some key financial metrics that show up first. So I come at it from the other side, which is, what are the companies that are already successful in demonstrating these attributes financially? And I write in the book about financial statements being like a medical test, in that it shows you the results of the decision-making of a company, but it's after the fact. It just tells you what the symptoms are. So what I look for, given that as a fund manager, you don't have time to investigate every single company in detail, you have to start with the symptoms and you say, okay, which companies are demonstrating excellent health? How I know it's founder-led is, obviously you look at the share register and you can see very clearly if there are a lot of individuals involved. If those individuals are involved in management and on the board, then you dig deeper, and they oftentimes will be founders. The second thing that you look for is holding companies, because if they're generational founder-led companies, like, for example, Hermes, some of the old European companies, they're held by family, large holding companies, and that's fine too. Once you get a picture of the ownership, then the next thing I try and find is, what is the trend in that ownership? It's not so much that the absolute equity holding matters, it's more so the trend. Founders have an uncanny ability. If they're not the serious type, I call them the flippers, they have the uncanny ability to detect when their share price is overvalued and they'll sell down. This is quite prevalent in US founder-led companies, so it's an area that I've learned a lot about. It is kind of in Australia, we're kind of taking on that US type of mold here with our founders looking to raise money quickly, list and sell down. That seems to be the mentality here. In Europe, it's quite different. Europe has a more dynastic approach.
It's interesting that in the same conceptual framework, you're looking at companies as dynastic as Hermes and as recent as Meta, presumably.
I think it's useful to have different species of founder-led companies in a portfolio. The Hermes, the generational type of founder-led company, certainly has its place, because you know that the founder has set in stone the operating system for the whole company. through generations. They're not going to change. They're not going to be acquired by LVMH, as they did make a play for decades ago. They have a vertically integrated company that's set in stone. They focus on quality. They're not going to innovate that much, but at the same time, this company has produced phenomenal results over the past 30 years. I'm talking about a CAGR of, I think it's something like in the 20% per annum. And then it's useful to have another species of founder in your portfolio. And I call them the next gen type of founder. In the UK, I think there are some very interesting ones. And I'm speaking not as an author now, but as a fund manager running my fund. One that's in my fund is Wise from UK, a very interesting company. Not excessively priced at the moment, but obviously founders are very good at hype, so they'll build up the hype around their business. But that's a very typical next-gen company, I would describe. When I talk about the founder effect, and I'm speaking now as an author, the book covers a framework for management teams in general, and I draw upon lessons learned from founder-led companies, but they may not necessarily be founder-led companies. For example, Arista Networks in the US has delivered phenomenal results over decades. It is run by a professional CEO, Jay Shree, who's from Indian heritage in Silicon Valley, a female, one of the very, very few ethnic minority females running a Silicon Valley company of her size. She left Cisco to join the founders, and she's grown that company phenomenally well to the point that she herself is now a billionaire. I think she owns 3 or 4% of the business alongside the founders. So it is certainly possible to have these professional managers adopt this mindset, and you can certainly detect that through the numbers. But the book I write about is broad. The fund I invest in is purely focused on only founder-led companies, and it's split between stalwarts, which comprises about 85% of the portfolio, which is the rock, steady, robust, solid founder-led companies, and about 15% next-gen companies.
A lot of people who invest in these type of businesses you're referring to seem to be happy to allow the business to compound for them rather than them making active decisions. I buy and hold forever, a good compounder, the sort of Charlie Munger, once you've got a Costco, 10 times earnings, never let it go. You seem to have a bit of a hybrid approach where you're applying a valuation metric to what you're doing. Can you just talk us through that a little bit?
It's more of a Peter Lynch type of approach where you're sort of trimming your profits and recycling capital. I think the Charlie Munger approach certainly works if you've got the Maltais, the Costcos of the world, whereby they're relatively kind of stable founder-led companies, and they're very, in a way, predictable in how they're running their business. If you've got 15% next-gen companies that can run up, if you've got companies that focus on new products and services, and I alluded to before that founders have the innate ability to promote their companies because they are the face of the company, then what you can end up happening is companies can get overinflated PE ratios over time. And this process can take years. When that happens, you have two choices. You can sit there and hold on to the company and believe that it will continue growing. But as we've seen, and one of the lessons I've learned is that PE ratios generally have a mean reversion tendency, generally speaking. A good example of that is BYD. That was speaking now as a fund manager. So I like this chat because it's a hybrid. A lot of the podcasts I've done so far have just been as an author. And I love nerding out on this topic in detail. So BYD is a good example. About a year ago, it was quite undervalued. Our fund entered into it, and we've made about 90% return already. And this is a live example. So you compare BYD, 90% up, PE ratio has gone from almost 20 times, maybe a little bit lower than 20 times, to now high 20s in the space of about a year. It continues to come out with new fascinating news. So in the past month, the 5-minute car charge, the God's Eye AI, and the drone deployment off the back of a car and the partnership with DJI. 3 really exciting developments. The hype from founder Lang Chuan-Fu has never been greater. There's so much fascination about the company that it's so much so that it's been written about in FT news for the past, very frequently over the
I have to ask you, what's the drone news? I haven't picked that one up.
So they've entered into a partnership with a drone company, DJI. And so this drone sits like one of those, the camping units that sit on top of a car.
Yeah, they sit in one of those.
Yeah, so they'll just deploy as you're driving. Yes. And you can read about this, like all these
I'll have to look it up, yeah.
Whether it's for photography, whether it's for, future traffic alerts, whatever the use case is, they've just announced the partnership. So it's a new innovation. Versus now you see in the US where stocks have come right down. And in some cases, I'm looking at companies like the Trade Desk, for example, that have come off about 50, 60%. And a phenomenal business in its own right with founders still at the helm. Now, for me, that's a great opportunity to look at that as an example, and obviously not making any financial recommendations because I can't, and obviously it depends on price and timing.
Yeah.
For me, when you ask the theoretical question, well, shouldn't you buy and hold? Well, not necessarily, right, in this situation.
You're of Chinese heritage, you're based in Australia. How do you think about investing in China? Because it's not that long ago where most mainstream investors, certainly in the UK, I don't know what it's like in Australia, would regard investing in China as being literally uninvestable. Yet, if you've missed that trade, you're probably down by 30, 40% in the last few weeks.
There's a narrative in the world at the moment that says it's East versus West. And a big theme of our chat will be diversification and risk management, which I come back to. Is China is a huge part of any risk mitigant in a portfolio. As we see the world polarizing and separating into its trading blocks, there will be a decoupling in correlation of stock markets. We see that now already. About 30% of our portfolio in the first fund, the Global Founders Fund, is in China.
Okay, interesting. I mean, that's a big overweight position relative to any benchmark. Not that I think you're necessarily directed by any benchmark.
Yeah, correct. And that 30% has grown over time. As you mentioned, has had a successful run over the past year or so. And that's why, I will actively look at trimming that portfolio. So I'm relatively regionally agnostic, and I kind of go where the valuations are favorable. So I imagine the next step will be shifting capital from China and potentially Europe. Europe has had a strong run too, back into the US. And that might be the next move as we see where the US goes next. It's still early days. I wouldn't say that the fall in the US is significant yet. They're still way up. That's how I kind of think about the macro picture, is looking broadly across the regions, making use of the lack of correlation and using that to your advantage. If everything moved up and down together, it would be hard to trim profits and recycle into something cheaper and more undervalued. This world in which we live in now presents that opportunity.
So you're sieving tens of thousands of companies globally. You're screening them to find a founder-led universe. You say it's 1,000 stocks. Ultimately, as you write in your book, you've got to get inside the mind of the founders. You've got to find the founder mentality. And presumably to do that, you've got to talk to management and talk to the stakeholders, the customers, the suppliers. I don't know. How do you go about doing that?
The 1,000 stocks, there's a step in between. And of the 1,000 stocks founder-led companies, they're not necessarily all great founder-led companies. So I'll shrink that down to 200, and they're companies that I have great interest in and actively monitor the financials of. And from that 200, I consider that sort of like the bench. If we use a football analogy, maybe the 20 to 30 stocks will be your starting team, and you've got a bench of 200. When you're looking to recycle, you draw upon the bench. You're still looking for excellent companies on the bench, but they might be underappreciated at the time. A lot of fund managers will say, you need to meet management teams, meet them in person, get to know the body language. And as I write in the book, a lot of management teams are trained with media, they're trained with investor relations. Founders themselves, ever since day one, are trained innately to promote their company and raise capital and spin a positive story. And I say they don't air their dirty laundry. It's actually very, very difficult to get behind the truth through a face-to-face meeting in person. It's actually more useful to actually visit the factory floor or be on the ground where the customers are. I find that a lot more useful than speaking with them. And I might speak to management. There's one company in Italy called Reply Spa, which is a IT consulting firm. They run a very interesting business. I met with their management team. That's one of the motivations for me writing the book, because there's this kind of mythology around fund managers having access to management teams and being a huge advantage. And when you look at what they actually say, they're actually saying, well, I just read the body language of the team and I can tell if it's good or bad. That's useful if you're trading in the next quarter.
Yes.
It's not useful if you're actually thinking long-term. Do they have actual potential to grow a business over 10, 20, 30 years? And so this book actually runs through my thinking on what is a better framework objectively to analyze this scientifically. And you're looking at track record of judgment. You're looking at alignment and their motivations. You can observe those things, as I mentioned in the book. And then you're looking for things like influence. Do they actually have the ability to shape an industry? A good example of that today is Jensen Huang. He's shaping technology. He's not even talking about NVIDIA that much. He's talking about AI, and he's the face of AI. Those are the types of founders that can really propel a company. If you have that influence, you have the alignment, and you're making good judgment calls. I've written about a few examples in the book on how you can spot those things. And that's what really drives the long-term success.
Are there any yardsticks around this idea that a founder can take a business so far? He might be able to IPO it. He might be able to get it to, 100 million market cap, get it IPO'd in some market. He used to be able to do that in the UK. Maybe he can, maybe he can't now. But get it across the line, get it IPO'd, get your shareholding into a liquid form. Maybe the next generation can't quite cut it. This is his saying, in family businesses, it's shirt sleeves to shirt sleeves in 3 generations, I think.
What I've seen that's been successful are founders and one founder said this to me, he said, the way I want to run my company is one day I actually want to run it so that I can no longer be involved. And it sounds like a contradiction, but what he meant was creating an operating system for the company that can disseminate broadly, not become a triangular bureaucracy like we see with big financial institutions or government as a worst case scenario. Retain that entrepreneurial spirit, but without me being the bottleneck as the sole person. And so there's all these interesting ways to set up your organization that can enable that. So the first step really is to look for organizations that are relatively decentralized. He's not a technical founder, but Warren Buffett is as close as a founder as you can get to Berkshire Hathaway. And he runs a very decentralized system. And I run through a few company examples in my book about that. It's the ability to set your company up in a decentralized way that limits the number of people involved in decision making. And so you can spot that. These things you can see in annual reports. You can see the org structure. You can see the delineation of roles, and you can see how they're set up. Another example is Reply Spa, the IT company I mentioned before. They call it a supermarket or shopping center of companies. Within the holding company, they have about 200 separate companies. And the reason they do that is it takes the philosophy of the founder and it instills that founder mentality into the individual companies or teams. And that setup is a powerful way to overcome the bureaucracy that can creep in as you get bigger. And it also enables you to shift away from the bottleneck of having to pass on to a family member. And it creates a system where it's more of a meritocracy for people, for talent that wants to develop in your company.
You mentioned Wise as being an example of a company that you have invested in based in the UK. What else is on your bench?
One of the lessons I've learned also is to really focus on profitable companies. I see that more in European companies rather than US companies. A lot of US founder-led companies like to run at a loss. And that for me is one of the lessons I've learned is quite risky. So you want to really limit the amount of holding you have in that category. Loss-making, excellent growing founder-led companies, contain that and focus more on profit generating. Some names that we've invested in for a while now and I like and are relatively undervalued. CTS Eventum is a European ticketing company. After COVID was down 50, 60%. We entered into that. It's bounced back very strongly as events come back, sporting events. Adyen is a next-gen payment company based in the Netherlands. Now, Adyen's interesting because even though it is a relatively young company, I mentioned before that it's not like a US company in that it's very much focused on generating profits. That's why I like those styles of business where it's a new product, a new service, a hungry founder, and profitable. A rare combination, but possible. On one hand, you've got the CTS Eventum, which is a rock-solid stalwart that's a lot older in terms of a founder-led company. Adyen, new product, new service, younger founder.
What's your average holding period?
Average holding period is about 3 years. That's a very generalized time frame, though, because some stocks can run up very quickly in a short period of time. And in that case, you do want to trim. You don't want to just hold on to it because the multiples will come back down at some point. It's unlikely to grow that much further from there. So it's more of a risk mitigation strategy when you're kind of trimming and recycling than anything. Average holding time of 3 years. There are some that I've trimmed sooner than that. Some you may need to hold longer than that because no one can ever pick the bottom. So, I like to buy in a more reasonable valuation, which often means that there's some sort of negative macro news going on in the background. Classic example now is in the US, where there's a lot of negative macro news. Yeah. Stocks come down, but who knows how much longer this negative news can go on for. But does it present a good entry point? Probably yes.
I think that you've hit on a really interesting current theme for the market. I mean, it's being billed as the end of American exceptionalism. Now, I don't know about you, but I think America's pretty exceptional.
Yeah, I think if I'm put my fund manager hat on, for my fund at the moment, it is a good time to enter. And the reason I say that is because you have overvalued companies and profits that you've generated from China and Europe. Yeah. And at the same time, this opportunity in the US presents itself. So it would be, yes, a good opportunity. So it's kind of portfolio dependent. If you're running 20, 30 stock portfolio, you do want to think about where your current exposures are and how you can shift that capital on a macro level. So for me, it's a yes, but it's investor dependent on your overall portfolio.
And who are the investors? Who are your investors typically?
A lot of individuals, a lot of founders. I've got some founders who have sold out and interested in diversifying their portfolio so they understand, what the philosophy of the fund is. And wealthy individuals like doctors and lawyers and, people that generally have a long-term mindset with investing. And I like clients that are relatively well educated in terms of investment strategy because I find that equities investing is very different to something that's easy to understand, like property investing, for example. Equities investing is more of a philosophical pursuit because your style can evolve and constantly change over time as the world changes. And that dynamism is what interests me in equities investing because you're looking at companies and not a real asset that's static. But at the same time, a lot of investors may not understand that component of needing to evolve and change with the times.
I don't know if it was Munger or Buffett or someone else who said, you get the investors you deserve, whether you're a company or a fund manager. I guess that's the same. You're an asset allocator. But if you're taking a view on your 20, 30 founder-led businesses that are going to do well for you over the next decade, you've got to put a lot of trust in that asset allocator to put your pounds and dollars with them, because what does success look like? How do you get measured on that basis if the asset allocation, the capital allocation decisions we're basically investing in are going to take a decade to really measure properly?
With any concentrated portfolio, you will end up with a potential to vary significantly from any benchmark, which is usually comprised of thousands of companies. But there is no better company that I would like to allocate capital to than people that have even more concentration risk in their personal life because, they're putting all their time and effort as well as capital and money into these companies.
You make money by concentration. You preserve money by diversification. And I guess your approach with 20 or 30 holdings on the rotation, you get a bit of both of those effects. But you're essentially outsourcing to a group of founders who you've handpicked from a very large universe.
That's a very apt summary. And I also imagine that just as corollary that personal investors that don't want to give their money to fund managers and manage their money themselves might have the same mentality too, because on a philosophical level, it's not about how concentrated you are, but it's more about control, isn't it? You can de-risk by having control over actions you take, just as a personal investor does by controlling your own portfolio. Yeah.
If you're a decision maker sitting in a hierarchy of a very large organization, you don't actually have agency. I think the classic founder decision for me was Netflix decision in the mid-2000s when they decided, basically, Reed Hastings decided that sending the DVD through the post, which everyone knew Netflix for and loved it, and it generated all their revenue and cash, was yesterday's business. And he was going to invest millions, if not hundreds of millions, into digitizing the offering. And the share price crashed. If he didn't have the agency to be the founder of that business, to carry that decision through, it's probably likely it would never have been made in a more hierarchical organization, because he wouldn't have been able to put it into effect. You have to make the right decision, and you have to have the agency to be able to execute it.
The way I articulate in the book is about cognitive biases, group cognitive biases. Oftentimes you sit in a board and you'll end up with the most conservative voice taking control because everyone is scared of doing the wrong thing on a board. Whereas a founder, if they have control, they have the ability to influence outcomes. And when I talk about long-term, it's a very esoteric sort of term that many people throw around, but that's a classic example of a long-term decision. Because in the short term, it would not have been easy to digitize your product. It would have cost a lot more in capital expenditure. You would have had to have researched, built out the digital platform. You would have tried to get users on board as soon as possible and get content digitalized, speaking with different content providers. Back then, it was all DVDs and things. You'd have to put it into a format. This would not have been a cheap exercise. And so the mantra is short-term pain for long-term gain. And these founders have the ability to do that. I mentioned in the book you mentioned before about problem solving as well. A good example of that is, Reed Hastings had to solve a particular problem in his business. Flight Centre in Australia, I think they might have a few shops in the UK, Flight Centre.
They do. Yeah, they do, yeah.
Oh, okay. Yeah, so the founder there, Graham Turner, is nicknamed Screw. He ascribes to a tribes mentality. So he read a book written by an academic in London School of Economics, Evolutionary Psychology. And in this book, he wrote about how people like to work in general. And because his particular problem was, how do I scale a business that is a person-to-person bricks and mortar business, very client-facing, and not make it so bureaucratic. So his solution was a tribes approach where it's found since our evolutionary past that people work together best up to it's called the Dunbar's number, up to about 150 people. So he'd have families, which is basically a shop front of about 5 to 7 people. Family would then join up with other families to form a tribe. Particular tribes would then form a village. In the meantime, all capping at 150 people. And through that process, he would create fun little games that would incentivize different villages and tribes to compete with each other. They would have a village elder that would effectively be a partner within the business, therefore motivated to grow the business as an entrepreneur. And that's how he has scaled this business from 3 shops in Australia to a global business, turning over, I think, about $2 billion Australian every year. So
it's a great example of process innovation as opposed to technical innovation. How important, I guess, is being an innovator in what you're looking for, in looking for your founder-led businesses, or can they be found anywhere? Is there an innovative angle to it?
I want to tie that back to, these innovative operating solutions, back to the concept of control, because that's important for many companies that are not founder-led necessarily or relatively bureaucratic. They don't have that control. One thing is the intention to do it, but the other is to be able to get it through board and get that approval, which many companies can't. In terms of the innovative side, now with my fund manager hat on, yes, I focus on innovation because of several reasons. One is you don't want to be competing purely on price. In this day and age, where innovation is accelerating, you really want to capture that upside by capturing the first movers in the industry. With that, I've given some examples of Adyen and Mercado Libre. With the first mover, what happens is they can capture the market, especially if it's some sort of technological product. Users become attached to that operating system. The stickiness is a real advantage. It's hard to migrate away from that on a psychological basis. And then the competitors will start following, coming in, and then you might have pricing that comes down. A good example of that is the EV market right now. So we saw Tesla come in, first mover, had a big advantage, but now BYD is really taking the lead, and prices now you'll see start coming down. But the weakness of a company like Tesla is that they're not vertically integrated like BYD. BYD has mining operations, shipping operations, battery operations, the full vertical chain. And that gives them a huge pricing advantage to the point where I believe they can be the next Toyota. They can be the next mass market EV producer. And they're certainly headed that way. Not to say that they can be overvalued or undervalued during that journey, but they're certainly on the right track. And so you want to be in industries where you can capture that initial impetus before it becomes commoditized and price becomes a differentiator. A lot of the founders I've interviewed in my book, one of them said to me, a founder of Chemist Warehouse, he said, Lawrence, I don't enter into fights where I don't have an advantage. Otherwise, we both end up with bloody noses. I want to go into a fight where I have an advantage. Other founders have termed it as a differentiating factor, some sort of key advantage that they have, a strategic advantage, whether in operations, whether in technology, but it's something that other people can't get to, at least not for a while anyway.
Sure. Making the right long-term decisions, you have to make lots of decisions. And if you can make small mistakes along the way to make the bigger right decisions, you're going to be a much better business for it. But the mentality of more structured companies is that you can't afford to admit failure. I guess it comes back to this cognitive bias, the way the company is programmed from the top.
That's right. And companies like Google have done that well. They've managed to go to such a huge size, but still retain that ability to fail. Although I do note that they're going through, a lot of the tech companies have gone through huge restructures of late. So they obviously have over-resourced to some extent and become a little bit bureaucratic. But as you mentioned, they still have that mentality. So they are shaving their teams back down to try and get back to what they were.
It helps in the case of Google if you've got a core search business that, just throws off, I don't know how many hundreds of billions of dollars of cash flow every year. You kind of can then, I guess, afford to give people a bit of downtime to come up with crazy new ideas.
What I like to look for, and I write about in the book, is the setup of a company, because overly large boards, you can already guess they're going to be bureaucratic. Other clues, and you won't see many of my type of founders doing this thing, which is making very large M&A acquisitions.
Yeah.
You talk a little bit about kind of making small mistakes. A lot of founders that I've researched and met with and have invested in, they make small considered acquisitions rather than large headline grabbing acquisitions. It's a much smarter way to do things, less risk, but also less ability. If you make a mistake, you can back out of it very quickly. And they're looking for specific things. So Flight Centre is an example. They're not looking for a similar company to them. They're looking to acquire, for example, luxury travel business in a particular niche. So it fits very well into their expansion strategy. Good founders, very rarely will they take big, massive bets.
Yeah, very interesting. Lawrence, thank you very much for your time. I've thoroughly enjoyed the conversation. Congratulations on the book. Great read, very enjoyable, very informative. I'd recommend it for anybody who's interested in investing in companies, founder-led or otherwise, because it's a great toolkit for anyone who's looking to assess the quality of a management team externally to the business, which is essentially the job you're doing. Good luck on managing the fund. I will continue to follow your progress with great interest. And thanks for a very interesting conversation today.
I really enjoyed it. Thanks, Jeremy.
Brought to you by Progressive Equity.